In today's video, folks, we are looking at Oxy Petroleum. So now this company has been being bought up by Warren Buffett. I'm going to pull up an article right now. Price is around $60 a share. So Berkshire Hathaway has bought almost 6 million shares of Occidental Petroleum in recent days, bringing its stake of the big energy company to 200 million shares worth $12.2 billion according to a filing date Tuesday. Okay. Value of the purchases totals about $360 million. Warren really enjoys the stock. And I believe, I was reading through the article, skimming through it. Berkshire now owns a 22% stake in this company, which is absolutely massive. Last time I actually reported or analyzed this business, they were at roughly a 10% stake in the business. Now they're at 20. So they doubled their position. Warren likes energy companies. No doubt about that. So in this video, what we're going to do today, folks, we're going to look at the numbers of Occidental Petroleum. So what I'm going to do here, folks, is just bring it over to the StockSpec software. If you want to go to stockspec.com, you get your hands on this amazing software which I'm about to show you. But what we're going to do, folks, is run through the numbers. Ticker symbol in here, Oxy. The software is going to load up everything. We're going to run through the numbers of Oxy, figure out what they're doing right, what they're doing wrong, and find the intrinsic value of this company. So by the end of this video, you'll have an idea of what you should be paying for this company today. And we're loading up everything here, pulling up all the lovely data. Take a look at this. Occidental Petroleum currently trading around $61.95. Call it $62, folks. Currently, it's pretty much an even split on the board here with the financial evaluations. Now, this takes a look at the company's financial statements, basically what they've been doing over the last 5 years. 5 out of 10 score, not too great. Let's see what they're doing right and what they're doing wrong. Right off the top, the price to earnings ratio is sitting below that 22.5 metric that we're looking at. It's a very fair multiple to pay for those earnings. And actually, take a look at the trailing 12 months in comparison in the company metrics category, currently sitting at 4.58. Look, folks, I'm a value investor, and I love seeing companies that have a very low PE ratio. Anything over 22.5. To me, it's just you're paying an extreme premium for those earnings, and there has to be an expected growth to make that price earnings ratio justified, which hardly I found in any other company not being able to do that. So back on task with Occidental Petroleum. Current ratio currently sitting below 1.5. Not the worst. They have a 1.10 current ratio, which actually isn't too bad. That just means that their assets to liabilities is pretty much on par. So they have enough assets to cover those liabilities. However, they're not leaving any wiggle room in case that does happen. In case this is like worst case scenario, which honestly I'm a huge fan if there is that buffer zone, because when economic conditions kind of get uncertain, a healthy current ratio is great to see. The return on equity is also the negatives, which is they're losing a point there. So far, they've earned a point with the price earnings ratio, lost a point with the current ratio, and return on equity. But EPS growth is up over the last 5 years, which is phenomenal to see. They have extremely high debt to equity ratio, which I don't want to see. That means they're heavily leveraged in debt. So not the best course of action right now for this company. However, 2020 was a definite hit for this business, and that is evident right over. Let me go back and I'll show you here, so you see from a visual perspective. Actually, you know what? Why would I do that? I have it literally loaded up here. Here, you can see it right here on the software itself. I don't know why I forgot. I have that, but look, you can see their net income really got hit hard. So potentially, in order to fuel their business, they decided to take on debt because, hey man, we got operations to fund. So not too great there with the debt to equity, not looking too hot. Also, the share dilution is up by almost 2%. So if you've been holding on to this company, you are getting diluted, folks, something to keep in mind. But the net income is up, free cash flow is up, revenue growth is up, really good. We like to see that trifecta in the positives and also increasing. And the return on invested capital, not too bad. It's a 5% return on invested capital. We're looking for 10% or higher. It's not quite there yet. However, in the trailing 12 months, they have been slapping it with 19.97%. It's 20% on return on invested capital, which is great. You want to see companies with a high ROIC because that indicates to us, folks, as investors, they're able to reinvest more reinvest less rather, and get more back, if that makes sense. And hopefully I'm explaining that as clear as possible. But the higher the number, the better it is. With Occidental Petroleum, not too bad. Let's see how that compares with the company metrics. So as I said, some things that do stand out: the low price earnings ratio, with a massive EPS on hand. So take a look at that, folks. You have, let's say, on average, the price earnings ratio was 21. Let's call it 22. But on 5-year average for the EPS, it was negative 1.91. That's over the last 5 years on average. However, compared to the trailing 12 months, you're getting a low price to earnings ratio with an extremely high earnings per share. So this is something to really keep in mind here. Like, huge jump in that number, something I love to see. Same thing with the return on equity. Although on average it's been in the negatives, they've shown massive return on equity. I can't speak today. I don't know why. They've shown massive return on equity trailing 12 months for 49%. Oh my God, I am struggling to speak today. I apologize, folks, but this company is actually kind of getting me excited a little bit. Let's see, 49% for the trailing 12 months return on equity. That's a massive separation from the 5-year averages that we have there. Same thing with the profit margin, 35% compared to negative 8%. I'm kind of seeing the trend here, and I hope you guys are too. So you see why Warren Buffett's kind of been going hard on this company? Look at the difference in the numbers. I've shown you 3 different numbers that were in the negatives. Their EPS, their ROE, and their profit margin, all in negatives for the last 5 years. But now, currently in the trailing 12 months, those numbers are astronomically high. It might be that that's the trend they're looking to follow. Look, it might be pretty evident. He has a 22% stake in this business. Warren Buffett is a guy that he's a very conservative investor. He doesn't like making mistakes, although he's made mistakes in the past. This doesn't seem like this is one of those companies. Free cash flow on average was $2.7 billion. They do pay a dividend, guys. Look at that, 1.13% dividend yield, which comes up to be $840 million paid out. Average free cash flow is $2.7 billion. That means that dividend is safe and can be paid out. But look at the trailing 12 months. Easily can pay out the dividend, sitting at 12.19. Guys, this business has been making tons of improvement. So here's the thing, folks, and this is why I love this software, because even though the financial evaluations is saying, hey man, take a look at this company, it's a 5 out of 10. It's not really like knocking, all these not earning a lot of points here. It's a 50% score. You got to look at the company metrics as well. Company metrics on this software here will show you what the company is currently doing to where it was comparable to around in the 5-year averages. This is why I love this software, because yes, in the last 5 years may have not been kind for this company, but this is the turning point, and this is kind of almost that pivotal point where you can now jump in on a company where it's just starting to take flight, and that's kind of where you want. You don't want to, if a company's already in the air, you may have missed the initial, let's say, run up. But anything that's kind of still on the ground, you're gonna have to wait for the takeoff. This is just about to take off, guys. That's what it's kind of screaming out to me. So let's take a look at actually their free cash flow, because that's something I love to see on businesses. Okay, here we go. Annual basis. I want to see how this free cash flow is kind of comparing. And look at that, 1 billion, 3 billion, 2 billion, negative year in 2015. Okay, 500 million, 1.5, 2.75, and then it skyrocketed in 2021 to $7.6 billion. Look at that. It went from $1 billion to $7.66 billion. That is absolutely insane. Okay. Very cash flow positive company overall, in the last 10 years, with the exception of 1 year. Now that could have been broken down to just other investment activities that have definitely probably paid off. But what should we be paying for this company today? I'm going to run this through here in the price analysis section, and what this section is essentially is an intrinsic value calculator. Folks, if you've been enjoying the video so far, hit that like button and subscribe button. This software that I'm using has a 7-day free trial, and as I said, a 20% discount on your subscription if you use the code found at checkout. So with this software, guys, it pays for itself, and you're able to research companies in an instant and find what companies are absolute bangers. Take a look at this, guys, and Occidental Petroleum might be this company. So I used some conservative revenue growth numbers, even though the last year the company grew its revenues by 45%. I stuck to the 5-year number of 22%, and because look, it is a $55 billion company, staying relatively conservative, along with a profit margin and free cash flow margin, sticking within this window of opportunity here that's been historically proven. I really took a discount to the free cash flow margin. That's like 13, 29%. I did 13, 14, and 15 with a very conservative price to free cash flow and price to earnings ratio. Desired return of 13%. Guys, take a look. Take a look. $303.18 is what I'm getting for this company. $300, and your current price is $62.14. Now, I know what you're saying, Leo. Hey, you know what? Maybe your revenue growth numbers are too much. You know what? You may be right. You may be absolutely right. So that's why I'm going to lower them. And I'll show you this in real time. I'm going to do 10, 12, and 13%. Let's just see. Calculate. Let's say if this company just grows at a snail's pace with very low price earnings ratio. Okay, look. Even with those low revenue growth numbers, $101.87. $101.87. Current price is $62.14. Guys, there's a reason why Warren Buffett's picking up this company. There's a reason why he owns 22% of the stake of this business. And he is a value investor. He's looking at companies that are priced incorrectly in the market with a decent margin of safety. I think with the number that I put in here, and that's me being extremely conservative. Look at the price to earnings ratio I put in. Look at the profit margin. I took the low end on everything, and it's still coming out to be a screaming buy. Even on the conservative average here, $64.49, that's fair value if you really think about that. If you really think about that, we're pretty much trading at fair value based off these numbers here. Now it's up to you, guys. Do your own due diligence, I think, because it doesn't mean you should go out and buy this company today. But from the way I look at it, from a numerics perspective, I love what's going on over here. I love what's going on over here because here's the turning point, as I said, in the company metrics. But in the financial valuations category, it's not looking too great. However, here's where I think the transition will happen. And then it'll eventually affect this. And we're going to see a lot more green on the board going forward. Mark my words. I'll make another future video about this in coming up. And you'll probably see this score change from a 5 to probably a 7 based off of what happens here. But that's the video, folks. $62 is the current price. Average calculation, $101 based off these very low numerics. But $300 looks like that might be the fair value with my other conservative metrics. If you enjoyed this video and you found it helpful, hit the like button, subscribe button, share it with one of your investor friends that are looking to improve your investing game. And once more, guys, get your hands on this software because look, it makes my life a lot easier, and I guarantee it'll make your life a lot easier knowing that what you're actually investing in, and you figure out what those numbers are and if it makes sense or not. Along with what I've shown you here, they also have the latest news articles based off what the company you're researching. We have charts that explain everything from a visual perspective, along with 10 years of financial data, and it's dirt cheap. It is dirt cheap compared to what other providers are giving you. So folks, that's the video. I will see you in the next one. Thank you so much for watching. If you enjoyed this video, make sure you don't miss out on this stock right here. Now, I believe this might be the potentially best investment going forward in 2023, given everything that's happening.